Welcome to our FinTech panel. Thank you so much for joining us.
Thank you.
So we use our smartphones every day to do everything from texting to booking a ride on your smartphone. But I think banking is still an area where we need to improve. So we have experts to talk about this topic today, about FinTech and the rise of FinTech companies. Thank you so much for joining us. So I wanted to start off this discussion today about whether the smartphone can become the fundamental banking channel. What do you think?
I think clearly it has, over the last few years, there have been great progress about advancing how actually consumers utilize and access their financial services. Clearly, the mobile phone, I think the key, there's really two areas where the mobile phone is making a big impact. One is on credit underwriting, so you're able to access a significant amount of data by way of leveraging access to a person's mobile activity. And then on the other side, the UI, the actual way that you interface and create a product that can be differentiated than traditional banks. So there's no doubt that the trend is favorable for utilizing the mobile device as a way to differentiate and provide a deeper level of value-added service than traditional financial institutions historically have been.
And Simon, talk to us a little bit about your business model and how consumers and businesses can use your platform to do banking on smartphones.
Yeah, so for us, what we do is to use mobile analytics and other data, right, to do credit underwriting for people that usually under the normal kind of conventional credit assessment cannot get access to loans, right? So one of the things we're trying to solve is credit accessibility. So for example, young adults, people living in rural area, students, these kind of people, if you use the traditional credit history-based approach, or if you ask for a piece of collateral, probably you will not be able to find anything for them. So how do you actually use a profile based on mobile data, based on a good understanding of them to grant them access to credit? And right now we're more looking at individuals and SMEs. So that's what we do.
And Kevin, you're based in the US, Cabbage is based in Atlanta. How is your business model different, and how do you use the smartphone to offer lending to small businesses?
Sure, so our model is, our technology is our DNA, and so we provide our technology to financial institutions around the world to better serve their customers and work with them in a partnership to do that. So to me, yes, the answer is the smartphone will be the primary banking channel in the future. It has two impediments. One is security questions, and the other is our fingers have not evolved to the point where they're small enough to really function on that tiny keyboard. But yeah, we provide our technology in a subscription model to financial institutions to put to work their brand, their regulatory licensing, and their balance sheet within each of their countries.
What do you think will be the first element of traditional banking to die due to the rise of fintech companies?
I think lending is a space that we're seeing a lot of people trying to crack it. I share with you a little story. Right? When we first entered into China, we did a China strategic plan. We look at, okay, what should we do? Like, how can we actually innovate this market? And what we discovered at that time, you talk about 2 years ago, right? The percentage of people searching for the word lending online on mobile is around 30% versus PC 70%. And we actually correlate that with smartphone penetration and the trend, right? You can actually see that both is actually creeping up slowly. And you do see penetration. Now, fast forward 2 years later today, the trend is reversed. 70% of people search for lending online, on a mobile, versus only 30% search for it on a PC. So you can see that actually this is an area that is working very well for FinTech.
And Barry, what are your thoughts on that?
Well, I think as far as replacing traditional banking, I mean it's more providing better products and being faster to market than traditional financial institutions. I mean I think traditional financial institutions still have very tremendous advantages when you look at even competing against fintech startups like Jimu. Clearly they have this regulatory advantage, where they have historically been operating under a very strict regulatory framework and are used to that. And the trend will always be towards more regulation for financial services. And historically, they have a massive capital cost advantage. So their funding cost is significantly lower. Where we can operate and be additive to the system is by providing innovative products, by utilizing technology to advance the user experience and provide access to credit where it traditionally has not been. So we see it as additive to the market. And so the idea of replacing certain aspects of traditional banks, I mean, clearly the technology is eroding some of the traditional ways of doing business that financial institutions have done from a long time, but they are smart as well and will move to adapt longer term. So we kind of see this as an ecosystem where fintech startups and fintech businesses are a catalyst for change in the industry, which the banks clearly are embracing, by the way, types of partnerships you see with for instance, Kevin's firm.
And Kevin, do you tend to partner with the banks, or do you see your company as more of competing with the financial institutions?
We see ourselves as partners with the banks. Clearly, as just demonstrated, banks have inherent advantages. They have the regulatory construct. Their cost of funds is something we in FinTech can all fantasize about. They have some problems associated with that, though. By taking deposits, they have a steady source of funds, and they're very inexpensive, but you get the regulatory overlay on top of that. And I think that's where we can partner, because as we come at this, banks come at everything from they start with, what's the regulatory issue I have to deal with? Where in a FinTech environment, we come at it from a customer standpoint. What's the customer want? And if you can develop it and then license it into or joint venture with banks around the world, then there's a huge opportunity to cover the globe.
And in your opinion, what jobs might become obsolete as a result of rise of fintech companies?
I would say with the use of big data and machine learning, the ones most at risk are credit analysts.
Interesting.
I think the second one is the sales.
Sales.
The physical feet on the street direct sales, a telemarketer, right? So what we look at ourselves in China is how do we actually scale up by having a fully online model? Meaning we can be able to scale up and down within, let's say, a matter of days, right? So it depends on your marketing budget, channel, everything else. You think about this, right? I think one of the things we learned in traditional banks is there are economic cycles. And when it's down cycle, what are you going to do with your sales, right? It becomes a cost if you're not growing the business, right? Being able to do fully online actually gives a fintech company huge advantage in terms of being able to respond to economic cycles.
Mm-hmm. And Barry, your thoughts?
I completely agree. I mean, it's the origination of business side, or loan origination side of the business, and then the credit underwriting and the convergence of utilizing internet technologies and big data as a way to kind of close the gap. And for our business, the major KPI for us on a monthly basis is as our businesses transition to a pure mobile origination and pure mobile decisioning, credit decisioning is the number of cases. Our borrowers that we approve on a monthly basis versus the actual number of underwriters that we have, physical people that are actually needed to approve a case. So, which shows you kind of on both sides, it's the shrinking of the jobs for the credit underwriters is really the key leverage point in that KPI.
What about the area that you would need to hire the most? Is it in data analysis?
Yeah, yes, we have offices in San Francisco where we have a bunch of PhDs that focus on machine learning. And then we have an office in Bangalore where we have a large pool of advanced mathematicians that do refinement and monitoring of our underwriting models. And those are the areas, if you look at the vast pool of data that's available now, that you can make underwriting decisions provided the regulatory environment allows you to use that sort of stuff. That's where the real advantage that you can make, because if you're lending out billions of dollars, if you can take a few basis points off your loss rate, it can have a tremendous impact.
And how does Simon WeLab use the data that you gather through your platform?
So it's actually very, very interesting, right? So the customer experience is very, very simple. It's supposed to be very simple. You download an app, fill in some information, take a few pictures, and authorize us to analyze some of the data about you, right? So with that, we actually build a very good customer profile. With a profile, we can estimate person's preference, lifestyle, life stage. And with such, right, we can actually find good borrowers and not so good borrowers, and we can even do what we call risk-based pricing to price them accurately. And the fastest decision we have is probably around like 21 seconds. So people get a decision within 21 seconds. We did a research. 74% of our customers will get a loan within 24 hours. Now that is something that is almost impossible if you put yourself in a traditional banking, fill in a form, that kind of context, right? Because by the time you fill out a form, they pass it around a few departments, it'll be like a few days, right? So that's what we focus on, right? Speed, efficiency, lower cost.
And Barry, any thoughts about the data analysis that you gather?
Sure. So it's the proprietary part of what we do, right? I mean, building credit models that are based upon proprietary data is a clear advantage. When you look at a market like China, which doesn't have a mature FICO credit scoring system, you can really create some proprietary or competitive advantages around the data. So we have kind of two different types of data that we use in our models. One is data that we scrape from the internet. And second is data that is opted in by the customer. So at the time of application, you're able to get access to certain types of data on their mobile device. It is very powerful when you're creating credit models, specifically around mitigating fraud, which when you look at lending in the China market is the major, more than half the losses are actually from fraud. So the mobile device is the central point there because there's so much information that you can get to prove who a person actually is and their existence that gives you a huge starting point when you're actually building the credit profile.
Mm-hmm.
I think, though, to me, the real power of all this data and the analytics is when you go into a traditional bank, they have a couple products that they're going to offer you, and they're not defined and built around your particular needs. With all this data, we should be able to come up on the fly with a product that fits your needs. If you think about a credit product, it can be defined on 4 dimensions: the term, the cost, how much you're going to pay, the payment schedule. Is it a traditional amortizing loan, or is it a balloon payment at the end, or interest only in the middle? And then this is there recourse or non-recourse? Is it secured or not? And we, with our technology and our data and our better understanding of your business than a traditional bank where you walk into the branch and fill out a series of paper applications, we ought to be able to offer you a product that best fits your particular needs in your business.
Mm-hmm. I want to shift gears to talk a little bit about expansion outside of your home market. Simon, let's start with you. So you're headquartered in Hong Kong, but you have huge operations in China. Do you plan to expand outside of China at one point, or is the market in China so big that you can grow exponentially in that market?
So obviously the market in China is huge. We can spend a few lifetimes there, and you still be working on it. But at the same time, with our recent Series B round of fundraising, where we have stronger international investors, we're also looking at whether we can scale this technology internationally. I think there are markets that looks interesting to us. We're still at a very, very early stage of doing so. But I would say that for the next market that we look at, we'll probably be looking at more a joint venture instead of heavily investing into setup in whole new operation in the markets. I think these kind of technologies are highly scalable if you think about it. If you talk about internet data, it's everywhere. If you talk about mobile data, Android, iOS devices, these are quite universal, right? So how do we actually put this technology in the best market, work with the best partners, and be able to scale up in the shortest period of time, not just to help ourselves, but actually to go back to help banks as well, right?
And Barry, Jimu is predominantly in China.
Solely in China, yeah. So we've thought about this significantly. We some of our shareholders do have resources outside of China that we can leverage into new markets. I think kind of the way that we've looked at it is all about opportunity cost. I mean, as Simon said, the market in China is enormous, and if you look at one of these provinces, it's the size of or larger than most of these Southeast Asian countries that are worth attacking. And when you look at entering into new markets as a credit business, you have very different factors that you need to consider. For example, the credit behavior of an underlying different culture. You also have the concept of timing. right? Which is the regulatory attitude in these markets. I mean, if you look at how we were able to scale up our business in China so quickly, is simply because of the timing of when we went to market. I mean, the timing of when we started deploying our team and building up was when the idea around consumer credit, marketplace lending, peer-to-peer lending was a phenomenon in China,
right.
and allowed us to get to scale very, very quickly. Whereas if you enter these new countries, there's all these different factors that you have to weigh. That some of them are in our control, but to be honest, most of them are out of our control.
Mm-hmm.
So when we look at opportunity cost, it's about focusing on the real prize, which is to capture significant market share in the China market and be a market leader for what we do there. And if we do that, then everything else takes care of itself. That's the current attitude. I think always open for change in the future, but for sure we're very focused on a clear goal.
Right.
I think another point to add on that, right, is also what we discover, economic cycles across countries are pretty linked, but not credit cycles. Credit cycles in each country is actually quite independent of each other. So being able to be in multiple markets also hedge the business risk as well.
Mm-hmm. And Kevin, you're in the U.S. mainly, but what are your plans for expansion? Would you look at China, for instance, partnering with one of your investors like Tencent, perhaps?
Absolutely. Our goal is to work with financial institutions around the world to provide our technology and our underwriting abilities to allow them to better serve their customers. So yes, other than, I don't believe there are any financial institutions in the Antarctic today, but other than that, our goal is to get into the 6 different continents, and we've announced licensing agreements in a number of countries already and are continuing to expand that effort.
What are the biggest hurdles, though, to expand outside of your home market? Is it regulatory issues?
So I don't perceive it to be so much regulatory because we're not trying to bring our own book of business into each of these countries. If that were the case, then yes, having to get regulatory licensing approval in each of the countries would be a huge hurdle. But our business model is to partner with financial institutions in a country where they bring to the partnership the regulatory licensing, they bring the brand and distribution, they bring the balance sheet, they bring access to the payment accounts because, again, this is a function of you're lending people money, you want them to pay it back. What we bring to the table is the software, the intellectual property, the underwriting abilities, and access and understanding of the data. I think the biggest challenge is, for us, our biggest challenge is our limited capacity to do these implementations at any point in time. So we tell our salespeople, in effect, to start slow rolling some of these. But there's from a software standpoint, if you partner in each country with people who understand the regulatory environment, know the language, know the brand and the culture, that's not. The impediment is being able to go in, define what the business solution is going to look like, and then schedule it into the implementation process.
I also wanted to get your thoughts on the valuations within the tech startup space. So there's been a lot of enthusiasm for FinTech startups. At the same time, the global economy is slowing down, and there's been concerns about valuations. Are you having any problems raising money in this kind of a difficult environment, Barry?
I think the market sentiment has definitely changed in the last 12 months. When you look at specifically to our market, China, there's been around fintech businesses in China. There's definitely some gray clouds around some of the malpractice that's occurred in the market. And similarly, looking at the U.S. markets, the only listed, the main listed fintech players, Lending Club and On Deck, have traded down significantly since their IPO. So I mean, clearly there's the trickle-down effect and impact on private valuations as these VC investors always look at the public markets as their primary exit. We haven't had any issues. We're very well capitalized. But for sure, when you look at the standpoint of the trends in the market, they're not favorable for the industry at the moment. But I don't necessarily think that's specific to fintech.
I think so. The challenge is the valuations in fintech have been mostly based on the concept of technology revenue with huge gross margins, 80%, where if you're more of a fin than a tech player, eventually your cash flows are going to come down to your gross margin, if you're good, is 20-25%. That's a very different world. And so, yes, what happened with the 2 listed companies in the U.S. have really put a damper. Thankfully, we're a private company. Otherwise, we'd have to worry about our stock price every day. Mm-hmm. I think it's had more impact on the credit side because financial dealings are based on trust. And what, unfortunately, Lending Club did is caused an evaporation of trust in the markets for at least a short period of time. And so we have spent a lot of time explaining to investor groups on the credit side as to why what happened there couldn't happen in the credit and securitization vehicles that we work in.
Mm-hmm. Simon, any thoughts? Final thoughts?
I think it's no doubt if the market is soft for primary and secondary fundraising for FinTech companies. But we're also seeing that for good companies, they can still raise good funds. To continue on what Kevin was saying, right? If you look at it, right, there is the first generation of lending platforms, which is very much let's say a P2P platform, which is very much a business model innovation, right? And then you're looking at this next generation of lending platforms, which is like what we're talking about, very tech-driven. You don't rely on traditional credit risk criteria anymore. It's very tech-driven, and you can actually, it's a technology innovation now, right? I think those will be the winners of the future, and they will be able to sustain and continue to grow the valuation. I think that will be the future.
Well, great. On that note, thank you so much for your insightful conversation. And
Thank you.
thank you, everyone.
Thanks.
Thank you.